We'll begin our conference. Ladies and gentlemen, good morning. I'm Alex Pollock of AEI. It's my pleasure to welcome you to our conference on Deflating Bubble in China, Lessons from Japan, and thank you all for being with us. The whole economic and financial world is wondering, as we know, what the trajectory of the Chinese economy is going to be, and of course, securities markets are reflecting this uncertainty. Our current developments in China, just an inevitable slowdown after a vast multi-decade boom, with a soft landing, or maybe not even a landing at all, but continued growth at lower rates ahead? Or is this something far more dangerous that we're watching, the deflation of a giant real estate and debt bubble with a stock market bubble thrown in, all intertwined, of course, which will lead to an ugly, long-lasting bust. Will China follow a path similar to that Japan did earlier, from an energetically modernizing state to a world economic and financial power, to huge bubbles, and to their extremely painful bursting and a long-lasting ugly bust? And if so, what does that mean for other countries, and which ones? Of course, all this presents a mix of economics and finance, with politics, with demographics, with military power and national ambitions. Where is it all headed? Our expert panel is going to, if not tell us, at least help us figure it out. Let me introduce our panelists in the order in which they will speak. First will be Bob Aliber, who is Professor Emeritus of International Economics and Finance at the University of Chicago Booth School of Business. He's worked extensively on international financial problems, including editing the reconstruction of international monetary arrangements. Time for that again, Bob. Another reconstruction. And Bob has also served as a consultant to the Federal Reserve, U.S. government agencies, the World Bank, the International Monetary Fund, and to me personally. Bob is the co-author of the 5th, 6th, and soon 7th editions of Manias, Panics, and Crashes, and a continuation of Panics and Crashes keeps him busy updating this classic work, which is, for those of you who don't know it, required reading for anyone interested in financial cycles. Next will be Yukon Huang, who is a senior associate at the Carnegie Endowment for International Peace in Washington. Previously, he was the World Bank's country director for China and the World Bank's director for Russia and the former Soviet Union. His research focuses on China's economy and its global impact. He was advisor for the joint Chinese government World Bank China 2030 report and has published widely on issues affecting China and East Asia. He's currently working on a book on why views of the Chinese economy differ so much. Perhaps we'll hear about some of these differences today. Then we'll hear from Derek Scissors, a resident scholar at AEI, where he studies Asian economic issues and trends. Derek focuses in particular on the Chinese and Indian economies and U.S. economic relations with China and India. He's also an adjunct professor at George Washington University, where he teaches a course on the Chinese economy, and previously, Derek was a research fellow in the Asian Studies Center of the Heritage Foundation, worked in London for intelligence research, taught economics in Hong Kong, and served as an officer in international economics and energy for the Department of Finance. After that, we'll hear from Nick Eberstadt, who is a political economist and demographer by training. Nick holds the Henry Wendt Chair in Political Economy at AEI. He's a senior advisor to the National Bureau of Asian Research, a member of the Visiting Committee of the Harvard School of Public Health, and a member of the Global Leadership Council of the World Economic Forum. He researches economic development, foreign aid, global health, demographics, poverty in North and South Korea, East Asia, and the countries of the former Soviet Union, and is the author of the books A Nation of Takers and The Great Society at 50. Our final panelist will be Desmond Lachman, a resident fellow at AEI and my colleague in organizing this conference, which we had a lot of fun doing together. Desmond focuses on the global macroeconomy, global currency issues, and multilateral lending agencies. Previously, he was managing director and chief emerging market strategist at Solomon Smith Barney, a deputy director in the International Monetary Fund, and he's written extensively on the global economic crisis, which seems to go on and on. Desmond, the U.S. housing market bust, the U.S. dollar, and the ongoing strains in the euro area. Desmond is known for his trademark accurate pessimism. Will this now be applied to China? Well, each of our panelists is going to speak from 12 to 15 minutes. After that, we'll give the panel a chance to react to each other, if they like, or to clarify points or raise new ones. After that, we will open the floor to your questions, and we will adjourn promptly at 11 o'clock. Bob, you have the floor.
Thank you very much. It's a pleasure to be here. I'm reminded. Thank you very much for the invitation. I'm reminded of the time that young Ernest Hemingway interviewed Albert Einstein. Hemingway was a magazine writer. It was in the 20s. And at the end of the day-long interview, Einstein said, "Hemingway, may I ask you a question?" And Hemingway said, "Einstein, Dr. Einstein, you've been very gracious. Ask me anything you want." And Einstein said, "Hemingway, you have two notebooks. You write down a lot of what we chat about in one notebook, but you haven't opened the other notebook. What's the second notebook for?" And Hemingway said, "Dr. Einstein, it's very simple. That's the notebook in which I write down all my good ideas. Surely you have a notebook like it." And Einstein said, "It is very sad. I do not have many good ideas." So I want to introduce you to one good idea today, which is the Andy Warhol theory of economic growth. Now, Andy Warhol, of course, is our most famous pop artist, and he's famous for one great quip. Everyone is famous for 15 minutes. The Chicago Tribune had a marvelous headline a couple of years ago. It was, "Ivana Trump has used up most of her 15 minutes." I sometimes feel I have used up most of my 15 minutes. But I've taken this quip, "Everyone is famous for 15 minutes," and bastardized it. Every country grows rapidly for 30 years, or maybe 40 years. So if we look at patterns of economic growth, the first country to industrialize was Britain. It grew rapidly 1830, 1870. Then its growth rate fell very sharply. The US and Germany began to grow very rapidly 1870 to 1920, 1930. Japan grew very rapidly. Well, actually, two periods of rapid growth, but the one I focus on is 1950, 1990, and then the growth rate fell out of bed. South Korea has grown rapidly. China has had 35 brilliant years of rapid growth, and it's over. So here are some of the things that happen during a period of rapid growth. Exports grow very rapidly. There's tremendous investment in plant and equipment, tremendous migration off the farms into the cities. Most countries import foreign capital. The United States imported capital for 100 years. Actually, I got onto this view because I began to ask the question a long time ago, why in the 1980s did Japan move from being a receiver of foreign capital to an exporter of its own capital? And that occurred at about the time that its growth rate fell. In the British case, 1870, Britain had completed the construction of its railroads. and the money the savings that had financed the construction of British railroads then went abroad to finance the construction of American railroads, Canadian railroads, railroads in the Argentine and in Australia. But the key is exports grow very, very rapidly. And during this period of very rapid growth, there's tremendous migration off the farms and the villages into the cities. And of course, some countries import a great deal of labor. I'm finding it hard to see that.
80s surge in real estate in Japan.
Oh, this is a story of the 80s surge in real estate prices in Japan. Where did this come from? Essentially what had happened is that the growth rate was slowing in Japan in the 1980s, and at the same time, Japanese firms were able to finance their expansion by selling bonds and convertible bonds for the first time. So the need for bank finance declined very sharply. The Ministry of Finance in Japan was worried about what to do, how to keep the banks occupied, and so it liberalized credit for real estate. Bank loans for real estate surge, and Japan had the mother of all asset price bubbles in the second half of the 1980s. Now that was in part a necessary adjustment to the decline in the capital outflow from Japan. That meant that Japan had to have a decline in its current account surplus, and Japan needed a massive increase in asset prices in order to induce a sort of consumption boom. Now, since the collapse of the bubble, I can divide Japanese history into two periods. The decade of the 1990s was a transitional decade. It was the adjustment of real estate prices. Real estate prices fell from 100 to sort of 25 or 20. Massive decline in real estate prices, massive decline in stock prices. And there was the rationalization of industry. Previously there had been overinvestment in industry. And then after the turn of the century, Japan has grown steadily but slowly. And the dominant problem that Japan has had for the last 15 years has been an excess supply of savings and a very large fiscal deficit. Now, real estate investment in China. 4 years ago, I was talking to our alumni in Beijing at a lunch, and one of the alumni said, it just moved into an apartment building, and he was the only one living in that building. I was just fascinated. And as I was driven around Beijing in the evening, I looked at the light patterns in the buildings, and many of them were dark. My next visit to Beijing, I asked a student, take me to a real estate office. And I sat in a cubicle as if I were going to buy an apartment. What's the price of an apartment? 600,000 US. How many square meters? 90 to 100 square meters. What's the income of those who are buying the apartments? 25,000. That means that the price to income ratio is 20 or 25. Real estate prices were phenomenally high. And when I would talk with people, I would say, do you rent or do you own? And if they would say they rented, I would say, what's the rent? What's the market price? And the universal answer was the rental rate of return was between 1% and 1.5%. And what had happened was that the real estate prices had surged. And they had surged because the Chinese had adopted the Japanese system of financial regulation. Some of you may be familiar with Ezra Vogel's marvelous biography of Deng Xiaoping, who went to Tokyo in the early 1980s, was impressed with how modern Japan was, and brought back the system of financial regulation, which really meant financial repression. Household savers had a zero real rate of return. Sometime in the early 1990s, the Chinese government told the entrepreneurs, sell the tenants the properties they live in at a very nominal price. And since that time, property prices have increased, and the real rate of return until recently on property prices has been in the order of 20% a year. Now, China has 20, 30, 40 million unoccupied apartments. I had been using the number 15 million until a couple of weeks ago. 15 million apartments owned by individuals acquired as a store of value, and then the most recent Article 4 consultation report from the IMF says that there's a supply owned by developers of 2 to 2.5 years of apartments. That's figure 10 million apartments a year, and so we're up to 30 to 40 million unoccupied apartments. The migration from the countryside to the city is over. There is no one in the countryside between the ages of 6 and 60. So the cities are going to stop growing. Property prices are going to fall. And China is going to reproduce the Japanese experience. Now, I think that following the Japanese experience, I would say there are two periods. There's a transitional period, and I'm going to say that's going to last 10 years. But things happen in China more quickly than in other countries, and it could be 7 or 8 years. But in that 7 or 8 years, China is going to have to absorb 30 to 40 million apartments. And this means that construction of new apartments, which have accounted for 10% of GDP, are going to decline very sharply. You can write any number of scenarios on how rapidly the demand for apartments declines, and then ask how much of the demand will be satisfied from new construction and how much will be satisfied by absorbing the inventory. In 2006, we were producing 2 million, we in the United States were producing 2 million apartments a year, and then in the slump, we were producing 500,000. We were absorbing the excess supply. The second thing that is going to happen in China is that firms are going to find that they can no longer borrow from the banks. The Chinese firms have been involved with an evergreen finance. They've never repaid a loan. They've never paid the interest on the loan because the rate of growth of indebtedness was larger than the interest rate. The interest bill was essentially added to the capital. But as in Japan, that pattern is going to be rationalized, and there are going to be massive, massive bankruptcies. And this means that the banks are going to have to recognize the losses that have been embedded. It's as if they've gone for 30 years without recognizing a 1% per year loss, and now the cumulative losses could be in the order of 30 or 40%. So the banks are going to have to be recapitalized, and that means that the ratio of government indebtedness to GDP is going to surge. And then in the year 2025, this adjustment, or maybe it's 2023, or maybe it's 2027, I'll be invited back before then, I'm sure. China will move from this transitional period into a period of growth. And the question is, what will the growth rate be? So this is the post-transition period. And if I had to bet, I would say the growth rate will be 2%, plus or minus, could be 1%, could be 3%. But the dominant problem in China will be an excess supply of savings by households and firms that will be massive relative to the amount that business firms wish to invest. So let me conclude. What's the takeaway from today? It's the Andy Warhol theory of economic growth. Countries grow rapidly for 30 years. They're at the top of the economic growth hit parade, and then they nudge off the number one position by other countries that have much lower wages and can begin to hustle for the markets, the export markets of the countries that have previously grown rapidly. Thank you very much.
Thank you, Bob. Yukon.
do we have right now? Can you hear me? Yes. Okay, let's just go without it here. What we have right now is a situation where sentiments are really negative. They've turned extraordinarily negative over the last 6 months. The interesting thing is China's economic fundamentals haven't changed, but market perceptions are much more negative. So if you feel very negative, why do you feel very negative? Because there are three bubbles, potential bubbles, a debt bubble, and property bubble.
I'm sorry, can you hold the
Okay.
for the recording?
Oh, a debt bubble. Okay. Okay. There are three potential bubbles: a debt bubble, a property bubble, an equity bubble. It's hard enough to deal with one bubble. How can China deal with three simultaneously, each one of them possibly bringing it down? So if you're a pessimist, you're keying in on this issue here. Suppose you're an optimist. The optimist is, here's a country growing at 6 or 7 or what? It's extraordinarily distorted. The really question is, how can a country grow at 6 or 7% with so many imperfections in prices, allocations, inefficiencies? Most of those kinds of countries grow at 0 or 2 or 3. Yet, there are three potentially productivity-enhancing reforms, each one relatively easy to do. Each one could increase your GDP growth rate annually by 1%. How many countries do you see that? If you look at Japan, you can't find it. You can't find something that significantly elevates Japan's growth rate. In China, it is easy. So if you're a pessimist, you're here. If you're a positive person, you're thinking here. We don't know the new normal because it depends upon whether they go this way or this way. And let's very quickly look at where China is. Here's China, the red square, growing very rapidly, coming down, and it's right here. So what is the path that China's going to follow? Because here's Japan, Taiwan, South Korea, and Singapore. First of all, it's all on the same path. It's not like China's actually fundamentally much different. This is a structural maturation point. Now, people like to compare China today with Japan in the 80s or late 90s, but that's the wrong period. China today is Japan in the 70s, and Korea and Taiwan in the 80s. And the question is, does China go sharply down like some of these countries did? Does it go horizontally? Now, the interesting question is that the China today, compared to Japan, Taiwan, South Korea, and Singapore, at that comparable period, China is incredibly more distorted. Those economies were actually relatively efficient. So the interesting question is, China's at the same point they are, but it's got a lot more imperfections that the market needs to deal with. And that means you have productivity possibilities. Now let's look at the debt indicators. Here's what McKinsey says about China's debt to GDP ratio. Here is China. Very small. But here's China. Its debt to GDP ratio has soared. It's over 200%. But the interesting thing about China's debt to GDP ratio is that it is above most developing countries. It's below most developed. Now, when you think about it, that's just about right. China's not really it's not really developing. It's kind of logical, actually. That's right in the middle. Yet, the focus on the debt to GDP ratio is that this is an economy which is really in dire straits. And what do they mean by that? It's because the debt to GDP ratio soared. It soared by enormous percentage points in 7, 8 years. So the real issue in China is not its level of debt to GDP. It's the fact that it soared so quickly in 7, 8 years. And then, as Rogoff writes, any country where debt soars by that amount in so many years will crash. So why not China? Is there something unique about China that makes it different from every other country? And if we can find that factor, if we can explain it. And most people miss it. And here it is. It's the property bubble that Professor Aliber talks about. Property prices in China have gone up 400, 500% in 7 or 8 years. Extraordinary. In dollar terms, 700%. Surely an economy where prices rise by that much is a bubble, unless there is a reason that's quite different. And there is a reason that's quite different. It's that China did not have private property markets before the early 90s. So what you're going from is something like 0 to something. Now, after increasing by 700% in dollar terms, over the last 7 8 years, how do we know whether current prices are excessive or not? Well, let's compare with India, for example. Let's compare Bombay and Delhi with Beijing and Shanghai. What are the property prices in China compared to India? The answer is China's property prices are half those in India, even after a 700% increase. It's going to go up, and it is already starting to go up a little bit more. But they have a huge excess stock, and that excess stock is a problem. It has to be worked off. But it's not the same kind of stock that you think of here. It's due to very peculiar situations. Half that stock is what I call old socialized housing, incredibly well located but not marketable, but potentially extraordinarily valuable. So China's got a very unique housing issue. It's going from a socialist system to a market system. The debt surge, 2/3 of it was to finance the higher value of land. If that land has value, the debt is not a problem. If that land does not have value, you've got a crash coming. So that is the big question. Is it sustainable? And in fact, affordability is increasing, and you're going to have to work off the excess stock. It means growth is going to come down for a couple of years, but it's not a bubble. Now here's the equity market bubble. Tremendous surge in the Shanghai index by 150%. It collapsed by 40%, all in 1 year. Surely that's a real problem that reflects the fundamentals in the economy. The answer is it doesn't have anything to do with the economy. So how can it reflect problems in the economy when it has nothing to do with the economy? Here is the Shanghai index 10 years ago. It went up the same 2,000 to 6,000, collapsed in 1 year. And then the economy doubles, but the index doesn't change. So the fundamental thing is China's stock market has nothing to do with the economy. It does have something to do with policy making and all sorts of other things, but it's not an indicator of a problem. Now, what about the productivity potential? Urbanization. Professor Aliber says China is very heavily urbanized. It is. But China's urbanization rate, which is this solid orange line, let's compare it with Japan, Taiwan, Korea. China's under-urbanized. It's only 54% urban. It should be 60. It's going up to 70. And because it is under-urbanized, its service sector as a share of GDP is incredibly low, 45%. Should be 50 or 60. There's something repressed about this economy, both in urbanization and services. But if you can solve this problem, you can go back to the growth trajectory that these other countries had, but China has not. And of course, what is that problem? It restricts the movement of people. Only North Korea and China does that. And the productivity of the cities in China are 3 times the rural areas, 3 times, the highest in the world. In India, it's 1.8. In the Philippines, it's 2.2. You've never seen a country where the urban areas are so much more productive than the rural because of artificial restrictions on movement. But change that, tremendous productivity boom. Private firms have a rate of return on assets today which are more than twice that of state. That is a fundamental divergence that only occurred during the post-financial crisis period. The question is why? Why is it the rates of return of private and state enterprises were actually coming very close, then diverted, and now are extraordinarily wide? Eliminate that gap, GDP goes up by 1% per year. China channels a lot of money into the interior provinces. A lot of it goes to the far west. Far west only accounts for 18% of GDP. They do this for political reasons. They do it for equity reasons. Big problem. The big problem is rates of return on public investment in the interior is half of what it is along the coast. Change that allocation, growth goes up by 1% a year. So economy growing at 6 to 7% has some easy measures to grow at something higher. Will they do that? Unclear, but potential is incredible. Fiscal reforms are the key, because everything you read about China tends to be the financial sector, the interest rates, the capital movement, the banks. The problem is that the financial sector has nothing to do with the economy in China, nothing to do with the problem in China. It's a fiscal issue. It's a fiscal issue because government revenues as a share of GDP in China, socialist economy, owns all the resources, provides all the services. Surely revenues as a share of GDP would be very high in China because the United States is around 38%. In Europe, it's about 45%. So what is it in China? The answer is 28. extraordinarily low. And that's why all the money goes through the banking system. You have all these distortions. How do you solve this? It's a fiscal problem. And if you can't solve that fiscal problem, you're going to have financial hemorrhaging. So you got to address the debt problem. Fiscal reforms will help you address the debt problem. It's going to affect the urbanization process. It's going to change the way even the trade investment surpluses. China generates a huge trade surplus with the United States, 3% of GDP. It saves too much. Very few people realize the reason why they save so much, more than they do before. And there's only one little simple reason, but nobody gets it. It's because migrant workers in China, the 250 million migrant workers who now occupy 50% of the labor force in China and are paid fairly high salaries, they save twice as much as ordinary Chinese. They save 50% of their income. Ordinary Chinese save a quarter. And they save extra amount because they don't have residency rights. They can't buy housing. They can't send their kids to school. They can't do various things. Suppose you gave them residency rights, allowed them to do the same things other Chinese would do. What would this do to the economy? It would wipe out China's surplus savings. China would become a trade deficit country rather than a trade surplus country. These are things you can deal with. They fundamentally change the character of China. What is going on right now? The slowdown. Certain regions of China are collapsing. The commodity-rich countries in the far north. The service sector economies along the south and east are growing very rapidly. But you have a fundamental regional variation which we've never seen before. This is going to be a big issue in the coming years. And it's going to have major implications on its growth rate, structure, consumption, services. Second thing, which I think is really important, what do you really want to monitor in China to know what's going on? If you really want to know what's going on, you monitor wage rates increases because you don't have good numbers on GDP or production, but you do and you can monitor wage increases. Now here is something extraordinary. This is the growth of wages in China. 10% a year, every year for a decade and a half, unheard of. And it stayed up there. It's still up there. Now here are the peaks for Japan, Korea, Taiwan during their rapid growth, that period that I was talking about. They all went up double digits or higher, but much shorter period, and then they all collapsed. So the big issue here in China is when is it going to collapse? And something's going to change. But this is the big issue that one has to look at because it changes consumption, it creates political pressures, it changes the balance of payments, and it's been extraordinarily high for some period that we've never seen. The new normal. Bubbles are manageable, but leadership's commitment to the market playing a decisive role and fiscal reform is uncertain. You're going to have growth declining further to about 6% over the next year or two because the property market construction issue has meant that fixed investment is negative right now. It's going to take a couple years for that to work out. But wage growth will also slacken. But after the next year or two, we don't know whether the growth is going to go up or go down. It could go down if they don't do anything. It could go up if they do the productivity-enhancing reforms. But what I see in the near term is widening regional differences and much more volatility in key financial indicators. Let me just stop here.
Thank you very much, Yukon. While you're sitting down, you mentioned in the beginning optimist and pessimist. Jim Grant just defined a pessimist as an optimist who just got a margin call. Mm-hmm. I guess the question is whether there's going to be a big margin call in China. Derek.
Thanks. I'm going to focus more on deflation than growth, which means you're going to have to figure out some of the growth implications yourself. That's how economics professors teach. We just tell you what we're interested in, and then what you're interested in is your problem. I'm also going to focus only on China because that's my comparative advantage. I've been studying China for 22 years, which is, I think, the lowest amount on the panel. But I have some advantage in that I've been studying China pretty much predominantly for 22 years. So I'm not going to talk about Japan because I wouldn't do a very good job. My theme here is that China's deflationary tendencies are quite strongly and long-term established. They did not start in the last couple of years. The way some people are just turning to China might think. And if the world wants to escape deflationary pressure from China, it better fix itself because China is not going to fix this pressure, most likely, the most likely scenario. I want to start with a macroeconomic observation that turns a lot of conventional macro on its head, but you can show it in the data for China for at least 17 years now, probably at most 17 years, for a 15 to 17 year period, and that is this. Investment in China is supply, it boosts supply, not demand. It's dominated by corporate investment that hikes output with little demand side discipline. They're not responding necessarily to higher demand, so they just invest regardless of internal supply-demand balance. So it builds up capacity even though there is not necessarily a demand justification. Similarly, increasing money supply in China can be shown statistically and causally to be often deflationary, not inflationary. Again, the money supply can be primarily in the form of bank loans, which go to corporations, which hike output. So if you're used to thinking about the US or Europe, you need to think a little differently. It doesn't mean that every single time all investment is a supply boost and all money supply increases are deflationary, but that is frequently the case. And the reason I thought of this, and if it sounds really nerdy, sorry, you're going to hear me say some things when you think about them, say, wait a minute, high money supply is high liquidity, which is inflationary, not deflationary, not necessarily true in China. So given that as my little macro background, and please, I'd be happy to fight over this. I've looked at the data for a long, long time. Deflationary pressure in China is not really new. It's well entrenched. I started following Chinese numbers when I moved there in 98, and in 98 the State Council was saying that more than 3/4 of the goods, it was only goods, that it was following were oversupplied. This is 98, and it was after the Asian financial crisis, but they never got to a point in that particular tracking where only a minority of goods they were tracking were oversupplied. And that was okay. China grew, obviously, after 1998. It had faced consumer goods inflation due to inadequate production coming out of the 90s. There had been high inflation. So you can have deflation and still have growth. So just because there was deflationary pressure on consumer goods doesn't mean this is bad for the economy. There's a lot of good consumer deflation. If you don't believe that, go offer to pay your gas station manager an extra $2 per gallon and see how it makes you feel. The problem starts in 2003. The previous Chinese government, led by Hu Jintao, did a terrible job, absolutely awful, managing economic policy. People did not realize that for years, but they should have. We have a massive expansion in Chinese capacity in 2003. You have, using the Chinese number of fixed asset investment, we can talk about gross fixed capital formation, but for the Chinese numbers more dramatic, and so I want to be dramatic here, you have 9 years of 24+% increases, just piling up investment year after year after year, a good deal of it wasted, a lot of it creating capacity that there's no demand for. The imbalances that people talk about in the Chinese economy, there's too much investment, there's not enough consumption, they did not exist in 2002. They were created by that government, or under that government, I should say. And that's when the deflationary problem starts to turn pernicious. It doesn't immediately become pernicious in 2003, but you had consumer goods deflation, fine. China was growing healthily at that point. For some reason, the Wen government, Wen Jiabao, the premier, decides that they're going to massively expand supply. It's already expanding just fine, thank you. And then you get the beginnings of deflation being pernicious. So let's talk about now. You couldn't possibly surprise anyone that the period of rapid expansion in global demand for Chinese goods ended, and yet somehow it managed to surprise the Chinese government. There was not going to be a period where China was going to see its trade surplus grow, 30% year after year after year, and it was going to go on forever. And that's maybe sort of the general lesson we have here. Everything's going to go on forever until it ends. And then people get surprised, even though the seeds of the failure are very clear. The Chinese, when faced with a surprise contraction in global demand, not just the expected one, in 2008, 2009, doubled down on the wrong thing. You had a $1.4 trillion loan stimulus, which took all the excesses they had been building up, which could have been corrected by the global financial crisis. Oh my goodness, we can't rely on foreign demand as much as we did, and they raised capacity even more while demand is plunging. And the natural result of that, and both my colleagues have talked about it, is you have a sharp increase in debt. So for 10 years prior to 2008, China had been slowly reducing its debt burden, reducing its debt problem, and it ruins all that progress in a year, literally. Other countries, the United States included, had similar responses to 2008, 2009. They were in different situations. I would rather cheekily take a phrase that not someone on the panel, but one of my other colleagues coined and say, China had the gold standard for the wrong reaction to the financial crisis. And why we're sitting here today is because that's what that gold standard. Why you're talking about these bubbles, why you're talking about China deflation is they had an opportunity in that crisis and they completely blew it. We're seeing now the inevitable, I wouldn't call it a popping, but deflating of the investment bubble. That's good. It should happen. We want Chinese investment growth rates to drop. And that may be painful in terms of the headline statistics. I don't care about those. China's GDP exaggerated the health of its economy for years. We might get a situation where low GDP growth understates the health of the Chinese economy. That's fine. We need more investment deflation. We need more substitution of decent investment for lousy investment, which is going to, you could get something like 5% aggregate growth coming down from 25. China's money stock, again on the subject of painful but positive changes, China's broad money M2 is 80% higher than ours. It was just probably the most fascinating macroeconomic statistic you can find. They have a smaller economy. It's plainly not inflationary. That giant money supply causes asset bubbles is not generally inflationary. The solution is therefore not, as some people are saying, I don't think anyone on the panel is saying this, I'm pretty sure they're not, but the solution is certainly not to loosen monetary conditions further. You've already done this again and again and again. Definition of insanity. The solution is to increase competition for state-owned enterprise and state banks and to reduce the repression of consumption and achieve a better supply-demand imbalance. And if your monetary policy is primarily in the form of bank lending that goes to firms, which it has been for essentially the entirety of the reform era, loosening monetary conditions is just going to make the problems worse. So this is the challenge that China is facing. If you treat China as a conventional economy, and you say, well, their growth is slowing, let's spend more money. What you're going to get is firms spending more money on capacity, and you're going to get a worse problem. That's the trap they're in. They cannot use those tools. It's like the liquidity trap on steroids because they've been building up to it for 12 years. So what is the solution? The solution is reform, and this is where I think my colleagues who've spoken already agree the solution is reform, but we disagree on the outlook here, I think. I'm not putting words in their mouth, but I noticed that during their talks. You had 2 decades where GDP growth outpaced income growth by about 11% annually to 6% annually. The stats, they're real stats issues here, but we can get into those in discussion. There is no reason why you can't go the other way. In other words, you can have 2 decades where income growth outpaces GDP growth, and you get a healthier economy and higher living standards, even though headline GDP is very weak and everyone's clucking about it. Who cares? What matters is money in people's pockets. Try to spend your GDP per capita, see how that goes for you. So GDP growth I don't really care about. It's going to be very poor in my opinion. That's not what matters. What matters is delivering income gains. That would be the right way for China to reflate, would also be good for the world, and it is possible. The financial reform we've seen so far, the financial sector reform, has been positive. It's not nearly enough. You've had a handful of private banking licenses, which are great, but you need a large chunk of the financial system not to be subject to state orders as they were in 2009. When the banks, and all of us know Chinese bankers, the bankers knew the profit opportunities were disappearing, and they had to loan more. It wasn't a choice. They didn't say, this is great. All these firms are going to lose their export orders and some of their domestic orders. Let's give them more money. They were ordered to. You need a large chunk of the financial system that can say, no, we're not doing that. And until you get that, you're not going to get, other financial reforms don't really matter. The Chinese have just liberalized deposit yields, which some of my colleagues think are important. It's not. The banking system is a cartel. They're not going to compete against each other by offering higher deposits to savers. They're not. You can't drive state banks out of business, and if you tried, you'd be removed from your position pretty damn quickly by the party. So what you need is an element of banking that is truly commercial, and that's a gap that, I'll say one thing about Japan. I do not know what the Japanese banking system was like in the 1980s, but the Chinese banking system is not a commercial banking system at all. And if Japan is a commercial banking system, then the risks and opportunities available to China are different than the risk and opportunities that were available to Japan in the 1980s. Because it's not a commercial financial system, I, even more than my colleagues, don't care at all about the stock market. Stock market is just outgrowth of too much liquidity and government green lights, and then money flows into the market, and then there's a collapse. And this happens all the time because the financial system is immature. And it doesn't matter to the economy at all. You got 20 million angry, late-coming retail investors this time. It's a political problem for the party. It's 20 million people. 20 million people in China is not a lot. Now, the real estate market is much more important. There's more money involved, but you're not going to get away from real estate bubbles. This is normal. China has real estate bubbles. They pop, then they have another real estate bubble. If you want to break that cycle, if you want to take away real estate's pressure on deflation, real estate deflationary pressure, you're going to have to go with financial reform. That's the key here. You have to give people more options, including sending money out of the country, which the Chinese are scared to death of. Freely sending money out of the country. So financial reform is the key here. That's a way to fight the bubbles that we were asked to talk about. And we're taking positive steps, but they're really small and the problems are really big. Now, a second reason why I am very pessimistic about China being able to reform in response to their deflationary problems, because regular loosening of monetary policy isn't going to work. My main thesis is they're doing exactly the wrong thing on the corporate side. And they just reaffirmed this last month. Again, state-owned enterprises are going to be made more efficient. We invite private investment in state-owned enterprises. We're going to have cooperation. Wrong. You want competition between the private sector and state-owned enterprises to increase, and you want the state sector to be able to shrink. Yes, you are going to keep some parts of the state sector protected. I've wrote a paper for the State Council where I said, look, I've identified about 25 sectors that you guys are basically dominating. Cut it to 15. Do something to shrink the state sector. You reduce your debt problems. You reduce your overcapacity problems. You fight deflation. They just said the opposite. They just said no. Now they can change their minds, and hopefully they will. But until I see some willingness to shrink the state sector, especially in banking, but in a number of other areas where they have too much capacity and they're inflicting deflation both on their own economy and on the world, it's very hard to be optimistic about the reform choices that they have. And the reform choices that they have are the only ways they get out of this mess. So if I was going to do a macro part, not just a macro comment, not just a deflation comment, I'd say, look, Xi Jinping government is better than the Hu Jintao government. Not a high bar to clear, but they're better. But you have very considerable sustained deflationary pressures, and there's no sign that the Xi Jinping government is yet willing to cast aside state-funded overcapacity, which means, as I wrote, I've said this in print, and starting in 2010, China is headed towards stagnation. And there's just not going to be any real growth at all. I mean, they'll report growth because that's what the Statistical Bureau does, but there won't be real growth. It is not headed toward collapse. The way, at least on economic grounds, the way you get collapse is a political story, which is beyond my area of expertise, but a non-commercial financial system tends towards stagnation, not acute bubbles. You can't play it. Try to short. There's no equivalent of shorting Lehman in China. So I want to make clear, I'm not arguing for a collapse. I am arguing for long-term stagnation as the most likely scenario. So I have about 2 minutes left. I'll talk about the impact on the world. Yes, the U.S. is much less affected by this than the commodities producers are. We've already seen the impact on the commodities producers. Remember when Brazil had finally shaken off its problems? Ha, ha, ha. Fooled you again. I mean, that was always silly. The Brazilians were selling tons of stuff to the Chinese. They hadn't done anything in terms of, well, I shouldn't say they haven't done anything. They hadn't done what was necessary in terms of reforming their domestic economy. We have some adjustment here in our stock market already because we have these bellwethers that are dependent on China for revenue. It doesn't matter to our economy. If you own a lot of Qualcomm stock or Boeing stock or Apple stock, sorry. But as a full macroeconomic matter, those are minor incidents. What's going to matter for us, of course, as always, is our own decision making, which in my not that well-informed opinion doesn't look very good. So I am not talking about how well the U.S. is going to do. I'm talking about how China's problems are not going to hurt the U.S. that much. The global side is where I think it's more interesting. I think China is turning into, in some ways, Japan in the global story, which is instead of being a tugboat or an engine for economic growth, it becomes this anchor where it's hard to drag the world forward. The U.S. has always been the country dragging the world forward. By the way, if you're talking about contribution to global GDP, you don't use the country that raises the world's average. When Bill Gates walks into a room, we didn't all get richer. China raises the world's average of GDP growth. Who cares? If they drop the world average of GDP growth because of a drop only in China, again, who cares? You care about the transmission of Chinese GDP growth to the rest of the world. And if you care about GDP, China's been running the world's largest trade surplus, which means it detracts from the rest of the world's GDP. So what you care is adjustment. Sorry.
1 minute.
at least I get a minute. What you care about is adjustment in China's trade relations to the rest of the world, not their average GDP growth. China has never carried the world forward in a meaningful way. It's always been the U.S. They've certainly carried some countries forward. The commodity producers especially have been hurt. If China moves towards running larger services, say services imports than goods exports on a net basis, that will boost the world's growth regardless of what their GDP growth looks like. If they don't, then again, it doesn't matter what their GDP growth looks like. It matters what their interaction with the world is. China's true contribution to the world economy was checking inflation through about 2007. That contribution has been taken away not because of China, but because the world messed up. Unfortunately, if the world continues to mess up, we're not going to get help from China, most likely, because they're not going to be able to reflate their economy in a useful way. Thanks.
Thank you. Nick.
Thank you, Alex. Long-term growth trends are going to be my topic for the next few minutes. This is not an area where a whole lot of angels go in and tread around, but I'm going to use some international data over the post-war period to suggest what international patterns of growth, existing international patterns of growth, may have to tell us about China's long-term outlook. And when I say long-term, I'm looking not at the next quarter or the next year, I'm looking out 20 years. There's been a whole lot of work over the last 3 generations in economic research on international patterns of development. I mean, the hero of all of this was Simon Kuznets, who won the Nobel Prize for this in 1970, I think. And his, so to speak, children and grandchildren, even great-grandchildren, have been looking at strong, regular international patterns of economic transformation that characterize growth all around the world. We know that China has undergone the most rapid economic transformation of any country ever recorded. Its rate of measured growth has been faster for longer than any other place in history. What we want to know, though, is whether China is fundamentally different. What's happened in China has been fundamentally different from what we've seen everywhere else in the world, or if there are some similarities between what happened in China and what happened elsewhere, and if so, do those similarities give us any sort of information about what may lie in store in the future? Okay, so this is the portion of the program where I could put you to sleep by describing my nerdy little model, and I'm going to try to avoid that so that you don't either go to sleep or get the whirlies. There are a lot of ways of telling a story about economic growth, and all of them involve brutally simplifying a complex real world. The sorts of brutal simplifications that I'm going to use in this little model I'm going to show you go kind of like this. I'm going to say that you can tell the story of modern economic growth really looking at 2 basic sorts of factors. One set of factors has to do with human resources, and the other has to do with business climate. So if we're thinking about human resources, we think about things like health and education, and also urbanization, because urbanization actually increases productivity even after you take health and education into account. Yukon made that point, I think, very well in his presentation. On the other hand, you look at business climate, at institutions and policies. These have something to do with how efficiently you use human resources, with how well you, unlock the value of human resources. And in the next slide, I'm going to show you kind of what a simple, maybe you'd say simplistic model shows for the post-war world from, say, 1970 to 2010, using 120, 130 countries, okay? Let's try this. Oh. Okay. So we live in a world that, as I mentioned, is untidy and a lot of complicated things happen in it. My little model doesn't talk about some things which are hugely important, like natural resources, like capital, like technological innovation. And despite leaving out these tiny little things which have a lot to do with the course of human events, we can predict about 80% of the productivity difference across countries at any point in time and within countries over time. And when I say predict, I don't mean come up with a correlation. I mean tell you 5 years later what productivity levels will be like. So health, education, urbanization, and business climate, as measured here by the Fraser Institute's Economic Freedom in the World, we could use other things, don't do everything to tell us about the story of modern international economic growth, but they do a lot. For 4 little guys, they predict a lot. So what does this simple, or we might say simplistic model do in looking at China over the past generation? Well, we put all of our little things, our little ingredients into the model, and it says that China, for the period of 85 to 2010, should have grown a little bit over 8% a year on average. If we listen to the World Bank says China grew at about 9.5% a year on average for this 25-year period. So we're not all the way there, but we're a lot of the way there in using our little simplistic model, okay? Now, depending upon how you look at things, you can either say we fell way short with this model, or that we got most of the way there. The glass is, you can decide how full the glass is by looking at 8.1 versus 9.5. But keep that as background, because now we're going to see what this little model says about China's coming generation. We don't know what's going to happen with the business climate in China over the years immediately ahead, so we can't put that little ingredient in. But the UN comes up with projections about urbanization outlook and health outlook. And there are a couple of pretty neat projects going that try to look forward at what educational attainment is going to look like all around the world. One of them is run by Robert Barrow and Zhonghua Li. Another one's run by Wolfgang Lutz over in Europe. I used the American one. No offense to Wolfgang. He's a great guy. They're both very good. But if we put these if we take a look at what this simple model suggests for productivity outlook in China over this 25-year period, just on the basis of human resources, it suggests that for the working age population, you'd see a growth tempo of about 3.8% a year. Now, China's working age population is set to shrink over the period ahead. Its total population growth isn't going to be appreciably great at all. When you make adjustments for that, you end up with a projection of 3.5% growth based on human resource factors for an average of a generation. If you could keep up a rate of growth of 3.5% for a century, it would be fantastic. It would mean more than a 30-fold increase in whatever you're trying to multiply. But from today's perspective, there are a lot of people who wouldn't think that something that sounded like 3.5% would sound so exciting for China, obviously. All right, so anyhow, Alex and Des said to me, well, okay, Eberstadt, if your simple little model's so smart, what does it tell us about what happened in Japan before and after the bubble? Which is a kind of a reasonable question. So we don't have information that I can use here on business climate going back far enough for Japan, so we can just do the human resource side of the ledger. And our little simple model would have suggested, on the basis of the numbers about health and education and urbanization, that Japan's GDP before the bubble burst, for the generation before the bubble burst, should have been doing about 5.3% a year. And according to those World Bank numbers, Japan's GDP growth over that period was about 5.3% a year, so that's pretty close. After the bubble burst, from, say, 1990 to the present, the model would have said that given somewhat slower but still appreciable improvements in urbanization and health and education in Japan, the human resource contribution to growth should have been a little over 3% a year. But the World Bank says that Japan's GDP was growing at 1% a year or less. That's a big gap. I mean, that's a real big gap. And that's, I guess, what happens when you have a supply-side-based model looking at a serious post-bubble situation where there's a major lack of demand, structural stagnation, whatever you want to call it, okay? So, so to conclude, I just say this is illustrative of some of the big pressures that are facing China in the future. China's remarkable growth can be very largely understood in terms of the big surges in human resources and the big improvements in business climate that the nation enjoyed and that transformed things in a very fundamental way. The outlook over the next generation is very different, and I'm no bubbleologist, but if the Japan parable tells us anything, in post-bubble situations, the growth in human resources may be less of a predictor of economic performance in the future than in situations where human resources are utilized more effectively. So thank you very much.
Thank you, Nick. Desmond.
Thank you very much, Alex. And perhaps I should just start by complimenting Alex on the timing of this seminar. You know, when he came to my office some 2 or 3 months ago, China wasn't that much of an issue, but true to form, it's really couldn't think of it as being more topical. I'm not going to disappoint Alex in my pessimism about where we might be headed, but what I want to do is take somewhat of a different angle from the previous speakers and focus on how important or otherwise China is not only to the US but also to the global economy. And it's often said that US shouldn't worry too much about China. After all, US exports to China only amount to something like 1% of US GDP, so whatever happens to China is neither here nor there. I would take a rather different approach and just take a look at this diagram. You know, it comes from the IMF. It shows that China in 1995 was something like 2% of the global economy. Today it's something like 12% of the global economy. What is also highly relevant is that the global economy has changed now in that the emerging market economies now, together with China, represent something like 40% of the global economy. So my main thesis would be that if developments in China impact the emerging markets, and now we're talking about 40% of the world economy that is in trouble, it's very difficult to see how the other 60% that this is a non-event. What I want to do is just put up a couple of slides that would show that I'm more in Bob Aliber's camp, that what we've seen is a tremendous credit bubble, and these generally don't end well. I recognize that China is somewhat different from other countries, but these bubbles don't play out well. What I think is going on in China is that the slowdown that you see in the official statistics, which I'll put up a slide that will question how accurate those statistics seem to be, telling us what's going on right now. But what we're seeing is a slowing in the Chinese economy, and basically that is because China is trying to shift away from a model that was unsustainable, investment-led, export-led. They're now trying to shift it to a more consumer service-based economy, and that is a very big challenge. Now, it's particularly a challenge when you've got to make a dramatic shift because a lot of that investment has produced the overcapacity that we are talking about. And I think it's very important to talk about this in quantitative terms rather than in qualitative terms, to say that China has had a credit bubble and how is it going to deal with it. And this is a chart that gives me a lot of pause. Basically what it's doing is it's showing what's happened to private debt in China over the last 6 years. You see it's increased by something like 80% of GDP. And we compare it to what happened in the United States before the housing bubble. That is the blue line, or Japan, the build-up to their lost decade. And you see that China, the pace of credit bubble is something like twice that of the other bubbles. So the question one has to ask is, if you've got a bubble that is twice the size of the others, the Chinese economy has to be totally different from the others not to have real problems in dealing with the deflation of this bubble. This chart just indicates once again the magnitudes that we talk about. China between 2006 2013, credit expansion in China was something like 90% of GDP. It's double what was before the Japanese bubble, between the UK bubble, between the United States bubble. And just in terms of levels, if you're just looking at non-financial corporate debt, China just is total outlier in relation to all the other emerging market economies. It's something like 2-3 times. So my point is that you've had this rapid build-up in credit. If that comes to a stop, this is really going to be a big challenge for the Chinese to turn that around. I'm not so sanguine about the equity market, that when you wipe out something like $3 trillion from an equity market, I think it's going to have some impact. I agree it's not the be-all and end-all, but when you add that to private property markets being in deep trouble, that you've had overcapacity everywhere, investment is now going to have to change, this just complicates their life. As I say, China is somewhat different in that banks are state-owned. They've got a big pile of foreign exchange. They do have some room for policy maneuver, but it seems to me that they're going to have to address very big challenges. This chart, what it shows is that if you look at proxies for GDP, what is occurring in China is hasn't slowed down to 7%, but it's more like the 3-4% that you've got people like Willem Buiter, a whole bunch of people who've looked at the side from more bottoms-up approach are coming to that China is slowing very rapidly. There are very big challenges for policy. I'd agree with Derek that for them to ease monetary policy, they just would be building up another bubble, but it's not going to be very easy in any event, because what's occurring in China right now, which is another reason that I'm not so sanguine about China, is capital is flying out of that country at a rapid rate. Over the last 4 quarters, China has lost a mere $500 billion in reserves. It's telling me that not all is well in China. They're going to have to probably put back capital controls in a big way. They're going to have to really tighten this up, because otherwise they're going to have real pressure on the exchange rate. Let me now just turn to why I think China, can't be viewed in isolation, but really what you've got to do is look at it in terms of what impact does it have elsewhere. And I just suggest that there are two main impacts that it's got. The first is commodity. The first is on the emerging markets. Basically, a whole bunch of countries, particularly those in Latin America, relied on the Chinese super commodity cycle, to boost commodity prices. But if you take a look at what's happened as soon as China begins slowing, commodity prices now, we're back to levels that we haven't seen since 2002. And that is really very problematic for these emerging markets, because what they're finding is that capital is being withdrawn from them as well. That after the Fed pumped up, went through a couple of programs of quantitative easing, money flooded into the emerging markets. This money now is being repatriated. First time that we've had negative capital flows to the emerging markets. And what you're seeing is you're just seeing currency collapses. This is Russia, Brazil, Turkey, South Africa, Indonesia, major emerging market economies. You've got their currencies down by 30-40%, and that is a huge problem, because as the Bank for International Settlements keeps reminding us, is these emerging market corporates manage to increase borrowing in dollar-denominated terms by something like $3 trillion over the last 6 years or so. So what you're going to have is you're going to have real stress, real corporate stress in these emerging markets. The second reason that I would think that we're going to have problems from China going to the rest of the world is because what China's going to do is it's going to exacerbate the currency wars that we're now seeing. That China, what it's done over the last 7 or 8 years is it's had something like a 40% appreciation of the renminbi in real terms. And if they now have to get the economy going through lower interest rates, through a lower exchange rate, well, that's going to be problematic at a time that Japan and Europe are using monetary policy to cheapen their currencies to get matters going. So what I'm saying is that China, through the exchange rate channel, can have a very big impact on the rest of the globe. So to conclude, I'm in the pessimistic camp, and I would just turn around what Napoleon famously said. Napoleon famously said, "When China wakes, the world will shudder." I'm of the view that when China stutters, the rest of the world economy will sputter.
Thank you, Desmond. I want to thank all the panelists for a series of truly informed, interesting, and varied perspectives on this problem. I'd like to go down the panel just in the same order and give everybody about, say, 2 minutes, 3 minutes max to make any additions you want, reply to somebody else, clarify your own points. And Bob, why don't you start?
Thank you, and thank you again for the invitation. Let's imagine we landed in Japan in the year 2000 and compared the real resources with Japan in 1989. What would have changed? The population is still highly educated, savings rates still very high, many high productivity firms, and yet the growth rate fell very sharply. So China in 2020 is not going to be very different from China in 2010. The real resources will be there. The population will be slightly older, but there is an immense packaging problem. So it is appropriate to look at the real factors, but it's also appropriate, indeed essential, to look at the relationship between the amount that households and business firms want to save and the amount the business firms want to invest as the economy moves from producing large-scale manufacturers to producing services. Thank you.
Thanks. Yukon.
Let me just make two observations. I think the fundamental difference in perceptions about China, whether it's positive or negative, is heavily influenced by what you think about the debt. The surge in debt, most countries with such a surge in debt crash. Why isn't China going to crash? And what's the opposite view? The opposite view is this is actually a period of financial deepening, not a financial bubble. Now, why does that mean by financial deepening? What is financial deepening? It means that your financial system is trying to value assets which were not properly valued. And in China, that asset is property and land. There was no market for it. Now it's valuing it. That's why after the bubble, after the increase, China's debt to GDP ratio is actually average, despite the surge, because before that it was repressed. Now, the second issue I would look at is deflation. Is this a serious issue in China that you would worry about? Now, if you think about it, we usually don't think about deflation for economies growing at 6 or 7%. They're growing at 0, 1, or stagnating. We usually don't think about deflation as an issue for economies where wages are increasing by 10% a year. Here, they're increasing by 0. Most of East Asia, negative. Now, the CPI actually in China is increasing. It's 1 or 2%. Nothing particularly bothersome. What is different, of course, is that primary producer prices have fallen dramatically. The oil, the commodities, the metals. Is this a cyclical phenomenon which will go away? I think it will. Is this a fundamental deflationary process in China's economy? I don't think so. So I think a lot of this issue about whether you're positive or negative has to do with how you look at two very broad trends, which most countries you would take as really major problems.
Thank you, Derek.
Well, that's a good way to have a clash right off. This PPI has been falling for 4 years. I don't know what constitutes a cycle. Again, on the consumer side, you have a different perspective. There can be good consumer goods deflation, and there can be bad consumer goods deflation. And when you're relying on high food prices to keep your economy out of a deflationary period, that's probably not healthy. So we have a disagreement on how well established deflation is, and we have a disagreement. We may have a disagreement. I'm sorry. I have a disagreement with most of the field on when China's problems began. They certainly did not begin in 2013. Or 2007 for that matter, but they got worse in 2009. Second point is so that's on how well established the deflationary pressures are. I think everybody does agree that reform is the proper response, not stimulus, with some variations, I'm sure, on the panel. And I want to make one remark about that, which is urbanization is a proxy for created economic opportunities. You don't just move someone into a city and get their productivity to rise. They move to the city because there are opportunities there. If you don't create the opportunities, just saying I've urbanized doesn't do squat. So rural-urban migration in China came out of first special economic zones, which allowed wage increases in those zones, and then partial liberalization of the labor market, which allowed returns to productivity to occur in cities, so people moved. You don't create the opportunities without reform. And I'm not saying any of my panelists are saying this. I'm just reminding you, because sometimes institutions just sort of throw urbanization out there as if it's causal. The reforms are what's causal. Urbanization is a response to those reforms. Without the reforms, urbanization doesn't give you the productivity increases that we all want. Last point, Des was more sharply negative than I am, which is rare that anyone's more sharply negative than I am, on world impact. And I think the key issue here is that it could be the renminbi. I absolutely agree, and we see sort of panic in some East Asian countries about this 1.86% devaluation wrapped up in trying to do something for the IMF. You can imagine if you got you increase by a factor of 10, you get an 18.6% devaluation, you're going to see serious financial panic. I just think that's really unlikely. If you look at the rise, 95 to 2000, we had this discussion of the Asian financial crisis. The Chinese would have to devalue because everybody's devaluing, their real effective exchange rate is soaring, which it did, and Des put a great graph up showing that. We've seen this before, and they refused to devalue outwardly. There were some increases in export tax rebates. they have a capital outflow problem, which multiple panelists have talked about. You put a serious devaluation on the table and you misjudge the size of the devaluation and trading goes down, you're asking for an absolute capital crisis. So I don't see the Chinese devaluing in any major way. They'll slip some things, little things in there in various ways, which means I don't see as much of a threat to the global economy as Des does on that ground. I see the risk, but I don't see it being realized. And I see the people who are being crushed are the commodities producers. They started getting crushed in 2012. And frankly, they deserve exactly what they got.
Nick.
I don't want to talk about my simple little model, but I do want to talk a little bit about China's long-term demographic outlook. I'm not a demography is destiny boy, but I do think that demographics slowly but unforgivingly alters the realm of the possible. And we've gone from a situation where there were an awful lot of demographic factors that were fueling very, very rapid Chinese growth to a situation where now and for the foreseeable future, China faces very unforgiving headwinds. We've gone from extremely rapid manpower growth to a peaking of manpower, as conventionally measured, and manpower shrinkage for the foreseeable future, for as far as a demographer's eye can see. We've got extraordinarily rapid population aging for a population that isn't that affluent yet and doesn't have really strong public pension and health systems for taking care of older folks. We've got a couple of wild cards that are completely unpredictable, but probably not that positive, like the marriage squeeze, which is creating an army of unmarried and unmarriageable young men who are mainly going to be rural poor and poorly educated. Because of the way that urbanization has unfolded in China with this hukou system, we now have a majority of younger workers in the big cities who are essentially illegal aliens in their own country. Think of it as Soweto with Chinese characteristics. That's probably not that may be a wild card again. And then we've got this thing which nobody's ever really dealt with before and is kind of terra incognita. What happens when a society like China switches from a population pyramid to a notional 4-2-1 sort of family structure? How does that affect economic performance?
Just say what the 4-2-1.
Oh, excuse me. From if you have a one child norm for a couple of generations, for some portion of the population, you end up with 4 grandparents, 2 parents, and 1 child. How does a society where a large fraction of people have no sibs or cousins or uncles or aunts or extended family network to rely upon in an uncertain environment, how does that perform economically? I don't think we know yet.
I very much agree with the point made by Dr. Huang that everything turns on, does China have a debt problem or doesn't it? And the issue really is, was that buildup of debt, that 80 or 90% of GDP buildup in the space of 6 years, was that capital well allocated or wasn't it? When I look at the indicators, for instance, in the property market, when you see that the house price to income ratios or the rent to house price ratios, when they are indicating that there's been a massive property bubble, that you've built houses way beyond what you need, when the Chinese government itself recognizes that there's huge overcapacity in a lot of industry, my presumption is that that capital has really been very badly allocated, and that is going to be the challenge that they have to really deal with. And once again, I would just emphasize that we're not talking about minor amount of capital misallocation. We're talking about 80, 90% of GDP. This is really going to change their patterns. Just on the exchange rate issue, I think I really don't envy the central bank of China, that you really can't achieve the objectives that they might want to. If you lower interest rates, you've got a problem that you might be fueling future bubbles, but you've also got a problem on the external side. If there was capital outflow at a given interest rate, you reduce the interest rate, I would expect the capital outflow to get worse. And it's a question they really can't go, if they went to a freely floating exchange rate right now and they let the currency fall, not only would you have problems right through Asia, but you'd have Donald Trump jumping up and down in a presidential election, which wouldn't be too pretty.
Any member of the panel want to add a final comment before we go to questions and answers? All right, ladies and gentlemen, this brings us to our Q&A and your turn to ask questions. May I remind you to wait when you're called on. Wait for the microphone. Where are our microphones, please? We got back here. Okay, good. Wait for the microphone, then tell us who you are and what is your affiliation, and ask your question. I know that sometimes we are tempted to give a speech ourselves before a question. If you do that and you've exceeded 1 minute, you will be reminded by the chair that it's time to ask your pointed question. I'm going to start in the middle over here. Let's say this gentleman here, please. And Ryan, after he's got the microphone, maybe you can get our title slide back up on here so I don't have to keep looking at this graph. Yes.
Good morning. My name is Bill Hampton, and I serve with an NGO called SIL International. And I wanted to ask two super quick questions, and I'll be less than a minute. First is to kind of focus on this whole concept of human resources. One of the issues when you look at Japan and China, which to me are quite striking, is Japan historically is a very monolithic society, a very monolingual culture. You have the same culture and the same language dominating every single level of society and economy. In Japan, you don't have such a monolingual or monocultural society, and you have different languages and different cultures at different levels of society and economy. Is there a difference there that can create barriers to the human resources and the development of those human resources, specifically education and health, and is there equitable business development for all in that type of a scenario? And second, a part of that too is that urbanization is not always a good thing. It depends on what the urbanization is caused by and whether or not the benefits of that urbanization are equitable for everyone. My second super quick question is that economy doesn't happen in a vacuum, and if you look at the surrounding world events for Japan, as Japan developed in this time that we're looking at, and you look at the surrounding events that China is developing in, are they similar enough that you don't have to think about what external resources and external events are causing differences in policies that would create differences in outcomes? Thank you.
Okay, thanks. Nick, you start on the demographic question, maybe,
Sure.
and then we'll get someone else on the second question.
Urbanization isn't always pretty. Often, maybe, usually, it isn't pretty. The surprising thing about the urbanization process is that it generally seems to be associated with improvements in productivity rather than increases in poverty. And people who move to cities tend to be more productive. Cities can be much more inequitable. Big inequalities are more in people's faces in a small space than in more of the quiet countryside, I suppose we'd say. But certainly since the beginning of the industrial era, cities have been associated with kind of like growth magnets and growth poles for all of the problems with them. And with respect to health and equity, you ask a very interesting question about language and how that affects it. I'd have to think about that. I don't have a good response to you right off the top of my head.
Desmond, do you have a comment?
Yeah, just in terms of what the global setting is, I would agree totally that that is highly relevant for what the likely outcome is going to be. And what gives me concern is that China is going to have to make all of this adjustment in an international environment that is rather poor. You know, the IMF has just come out, it's downgraded its forecast, you know, that is the lowest it's been for quite a while. You know, you just think about it, Japan's in trouble, Europe doesn't look too good, emerging markets are in deep trouble. The only economy that's not doing too badly is that of the United States. So China, for them to do this kind of adjustment without having a very buoyant global economy, you know, that can lift them, I think that's a very big challenge.
Bob, you want to comment on the global setting for Japan in the, say, 80s versus China now?
Well, I first want to comment on Desmond's remark that the U.S. economy is not doing too badly. That says a lot more about Desmond than it does about the U.S. economy.
It was a relative term. I was judging the U.S. economy on a curve.
There is one big difference. When economies' growth slows, the firms in those economies seek to sell in foreign markets. This is a universal. And in the 1990s, the U.S. welcomed the surge in the Japanese trade surplus because Japan was a large, immobile aircraft carrier. China inevitably will seek to grow its exports, and it will be partly because of its size, but partly because of let's call it its view of equity in trading relationships. Let me say that again. Its view of equity in trading relationships will find that the rest of the world is hostile to a large Chinese trade surplus.
Thank you. I want to call on the young gentleman over here on the right here.
Thank you, Alex, for that compliment about my age. My name is Bert Ely. I'm a banking consultant here in town. Observation and then a simple question. Observation is that I think the assessment of the debt to GDP ratio in Japan is significantly understated because it leaves out of that.
Are you speaking of Japan or China?
I'm sorry, China. I misspoke. That the debt to GDP ratio in China is understated because it does not include the embedded losses in the state-owned banks due to all the bad loans they have in their books. And I think there's an analogy to be drawn between where China is today and where the U.S. S&L industry was in the late 80s before the S&L bailout. My question comes back to all the comments here today, and particularly the talk about reform. I haven't heard any references to reform in the context of the rigidities of the Chinese political system. Can the Chinese political system and the single-party control adapt enough and be flexible enough to implement the reforms that are needed? If not, are we on a collision course in China between these growing economics and demographic stresses on the one hand and the desire of the party to retain control?
Okay, thanks, Bert. Derek's going to take this, and then Yukon, maybe you want to come on.
Yeah, I'll take the debt question. Well. I'll stay away from the politics question. Thanks. I don't know what debt measures you're referring to. Certainly people who talk about, central government borrowing as a percentage of GDP or central government deficit as a percentage of GDP are not accurately measuring debt. I was just talking to the author yesterday of the McKinsey study, and where they got 28 trillion. My own calculations, which they had as mid-2014, that absolutely does include bad debts at state banks. My own calculations are for about 23 trillion at the end of last year. They did an estimate of off-book lending and how much indebtedness there was off-book that I can't do because I don't have a team of researchers. But the big debt numbers, the ones that we're worried about, and I don't want to put words in any of my colleagues' mouths, we're worried about them to some extent or to a larger extent. They do include non-performing assets. So the numbers you're getting out of, in the 20s for $1 trillion debt, those are the non-performing asset measurements may be too low. You may have a very clear view of that. I don't really. But they do include non-performing assets. I would say that I don't like GDP as a scale for debt. Debt doesn't turn over every year, and GDP does. What happens if you took a debt to GDP ratio at the end of January? You get some ridiculous figure. The better scale is a stock like wealth. And on a wealth basis, China's GDP ratios actually look worse because China's GDP sort of annual production doesn't add as much to wealth as a lot of other countries that have high debt, high absolute values of debt. So I think, putting aside the debate on the panel over the meaning of debt, we do have estimates of debt that are inclusive. It's hard to gauge their accuracy. A better way to deflate them would be wealth. If the higher estimates, like the McKinsey estimate or the most recent Standard & Poor's estimate, are right, then there is a quantitatively very large debt problem.
Yukon, you want to comment on the political rigidity or adaptation question?
Let me just comment very quick about the debt issue, though. First, I think we also need to realize that this debt surge and what happened is actually a mirror image of something which happened 15 years ago. The debt to GDP ratio 15 years ago went up by 50, 60%. Non-performing loans were 30, 40% of the banking portfolio. The government had to deal with it. It was a very difficult process. The current debt to GDP ratio surge does include unrevealed non-performing loans, which are officially 1% of GDP, 1% of the portfolio, which obviously is too low. Simulations show that it's probably going to be somewhere between 8 to 15% when it comes out. That'll push the government debt, local plus central, from its current 58%, probably closer to 70, 80. It's significantly higher, but it's not alarming levels that people talk about. The last thing I would say is corporate debt is very large. It's very hard to gauge the meaning of that because it includes SOEs, and particularly includes SOEs which borrow on behalf of localities, which are really local government borrowings. So it's a very hard issue to analyze. Let me go to the policy formation, the political issues. And I illustrated three for you. Urbanization, SOE reform, and regional investment. The government's third plenum policy statement of December 2013 said that the market would become decisive in allocating resources. Decisive is the word they used. They also say the state would still have a dominant role. So it's internally contradictory. So the question is, do they have the commitment or not? Not clear. They have actually put out a new urbanization strategy because they realize, as someone said here, it's not just having more people in the cities that matters, it's how you do it. Whatever, however, is different in China. China is the only country next to North Korea which restricts the mobility of people to the cities. So that's completely a different kind of issue. That's why it's under-urbanized. And the example that I use is South Korea. South Korea went from 20% urban to 80% urban in 30 years, the fastest we've ever seen. Now, China will not be that rapid, but China's going from 20% to 54%. And if they liberalize, it's going to make a big deal because having repressed it for 30 years, the potential productivity gains is exaggerated in the eyesight if possible. On the SOE reform, they just came out with a reform statement a couple weeks ago. Again, it was disappointing because they did not signal a willingness to really, what I'd say, privatize, but it did say something which has not been fully developed. It said commercially oriented SOEs will be allowed, in fact, to move to a structure where it might be actually largely privately owned. And it did say that they might be run, in terms of compensation and staffing policies, different from the strategic SOEs. They've never said that before. Now, on the third issue, it's really important but rarely discussed. Everyone knows that China invests too much. The investment rate has surged. Very few people realize that that increase is totally concentrated in 18 far western provinces. You take them out of the picture, China's investment rate didn't surge at all. Okay? Now, that investment surge, however, has very low productivity. It's driven by strategic issues. I invest in Tibet. I invest in Xinjiang. I invest in Inner Mongolia, obviously because I worry about my peripheral. That doesn't generate economic return. I invest because I have very wide regional differences in income. The coastal areas have a 2.8 times the income levels of the interior provinces. This is an extremely inefficient way to address certain objectives. If you don't address it, your return on investment is going to stay very, very low. And this, I think, is much more politically challenging than the other two because it has geopolitical significance.
Thank you. Bob, you had a comment on this, and then we'll go to the next question.
Well, I would point out that there are 11 million illegals in the United States and 250 million illegals in China. And the statement that there are two kinds of citizenship is really an attempt by one group to tax the other. And so urban China is essentially taxing the peasants. But I do want to come to one very important point. We all know that China has a very high savings rate. Some savings rate over time, and you have to end up with a high investment rate. Now you need to distinguish between savings and the accumulation of investments and capital deepening. That's the second adjustment. But the third adjustment is, how large is the supply of bad debt? My colleague on the right said it's 8 to 16% of GDP. All the countries I've looked at, Japan, the United States, when you have one of these bad debt problems and you begin to do the adjustments, triple the numbers, just triple the numbers. And so 2 years from now, the ratio of government debt to GDP in China will be in the range of 125% to 150%. We saw that in Japan, and the adjustments in China are just going to be much, much larger because the imbalances have been much more severe.
In support of that, I will give you Pollock's law of troubled lenders, and that is, however bad you think it is, in fact, it's much worse. I've had a question here waiting, and then I'm going to come to you, and then we'll come back and get you. I know you've been waiting. It's right here.
I like your law.
Thanks, Alex. I'm Lawrence Carew from the International Energy Partnership. Your esteemed colleagues, how much do we owe China? How much does the United States owe China?
I follow Chinese outward investment, and I've done some, I don't like the Treasury numbers, calculations on this. So the number has actually dropped from its peak, not just in the last few months when China is supposedly selling Treasuries, which we actually don't have definitive data for, but since their balance of payment surpluses stabilized, and then, they were still extremely large, but they stopped growing. If you want to talk about how much U.S. Government bonds China owns, it's about $1.8 trillion. That it's hard to catch up because the more detailed numbers are a little old. The monthly numbers are incomplete, and they treat Chinese buying through third parties as if it's independent until it's corrected later or partly corrected later. U.S. corporate debt owed to China is pretty small. U.S. consumer debt owed to China is pretty small. So I would say we're just we're under $2 trillion, not by much.
You include the mortgage-backed securities they bought in that?
That's part. That their position there has shrunk considerably. It peaked at exactly the wrong time. Chinese involvement in the U.S. financial system does not show a very wise pattern, let me say.
I have Bob wants to comment, and then Desmond.
Forgive me, sir, but I'm going to object to the question. No Secretary of the Treasury has gone to China and asked China to buy our bonds. We do not owe them anything. They made a deliberate decision to buy our securities. If Alec Pollock decides to buy Bob Aliber's IOUs, and Bob did not take the initiative to sell them, he may have an asset, but I do not feel any liability. We do not owe them anything. And this has been one of the most stupid investments ever on their part, but that's a different issue.
We did feel the obligation, though, in the Department of the Treasury, to make good on Fannie and Freddie's obligations to China. That's quite clear. Desmond? No? Okay, I have this gentleman right here, please.
Hi, Dick Morgenstern from Resources for the Future. I have a question for the optimists on the panel. You've talked about reforms, and there's been a number of different ideas that have been tossed out. I wonder if you could just toss out what you think are the potentially most potent reforms that would be helpful to China in the next couple of years.
Okay, what are the most potent reforms, Joe?
I'm not an optimist. I can answer that. I had the exact same question yesterday at Lockheed Martin. For me, both because of its knock-on effects and because of what it symbolizes, if you shrink the state sector, not get rid of it, if you do either one of two things, you decide a number of sectors where the state has been predominant are no longer strategic, which is obvious, and you can argue over how many, or you say, look, we're going to keep a state presence in all of these areas, but we're going to have one large state-owned enterprise that you can't drive out of business, but it's only going to account for 40% market share instead of where it often is 95. If you shrink the state sector, you address the topic of this panel, which is you reduce overcapacity, you reduce deflationary pressure. It doesn't solve all these problems. It addresses another topic of the panel. You shrink the state sector, you don't have to loan money to state-owned enterprises because they're never allowed to go out of business except at government behest. They're not allowed to go out of business for commercial reasons, so you're constantly supporting them. So you address your debt problem, you address your overcapacity problem, you address your deflation problem. You don't solve them, but you address them, and that knocks away through the economy. You increase productivity by getting rid of firms that are producing something that no one wants. The other thing is it symbolizes, that's a hard thing to do. It's really hard. And it symbolizes a true commitment to reform. So I like that because of its knock-on effects, and I like it because it tells me that is a government willing to take on the very difficult task. If, Yukon and I completely disagree on the meaning of the, or maybe we don't, I mean, he's in the middle and I'm way out on the right, because I'm always way out on the right. On the meaning of the September SOE reforms, I think they were completely empty. If you had meaningful reforms and you saw state firms disappearing, not just being merged into other state firms, that would flip me to being an optimist.
Other comments on most potent reforms, Yukon?
What have we been talking about in China as a problem? One problem is inadequate demand, excess capacity. And they're not going to be able to export it. Investment rates are too high. They got to come down. Consumption, people think, is going to take up the slack, and that's wrong. Consumption's been growing at 10% a year for 15 years. It's going to go down, not up. So none of the normal demand factors are going to work. So what will fundamentally change China? Can they control it? And the answer is a wealth effect. It goes back to land. Now, I talked about urban. Urban property has now been privatized. All that rural land is owned by farmers and shareholders in villages, but they can't sell it. So they own shares in stock. If you allowed them actually to sell their ownership in rural land, tremendous wealth increase for themselves. What are they going to do? Frankly speaking, they're all going to move to the cities. They don't move now because if they move, they lose the title to that rural land. Suppose you actually said you could market your rural land holdings. Tremendous wealth effect, down payment for moving. They move to the cities, and then what happens to the cities? Tremendous demand for housing, investment, consumption, boom, boom, boom. Your supply and demand issue is solved in China. Now, are they going to do it? Actually, they are. People don't actually know this because in the olden days, the government owned all the land. In the cities, when you bought a condo, and I own a condo, the government owned my land. I owned 70 years right to living in the property. I didn't realize this now, but if you buy a condo now in Beijing, you actually own the land. Very quietly. It's a major issue, actually, but very quietly done. No longer does the state own that land. You actually own the land. I didn't believe this would happen, but it's happened very quietly.
Other comments on the most potent reform, Desmond?
I don't want to talk about the most potent reform, but I do think one doesn't want to minimize the challenge of transforming an economy where you're going to be reducing the investment level from, say, 45% of GDP to 35% of GDP, where you've got to reduce 10 percentage points of GDP, you've got to really ask, where does that other 10 percentage points of GDP come from? And I don't think that that's going to be a very easy task. Whether you do a reform that might do great benefit in the long run, if you've got to suddenly reduce your investment because you've got overcapacity, you've really got a major challenge of macroeconomic demand management. And the rest of us are going to suffer it because they're going to try to do it through pushing their goods abroad.
Okay, right back here, the lady, please. Right back here, Ryan, thank you.
Hi, I'm Alexandra Vyers. I'm with the Cipher Brief, and I'm also a graduate student at George Washington University. So I want to focus back on the topic of this panel. Sorry, I didn't mean that to go back. But I'd like to know, in all of y'all's opinions, if China can draw lessons from Japan's economic collapse, and if so, what lessons can be drawn?
Okay, anybody want to take that? Any lessons China should draw from Japan's experience with its double bubble?
Maybe the train has left the station, that the lessons that they should have learned is not to have the bubble in the first place. And I think that if you look at Japan, Japan was very late in recognizing the magnitude of its problem. It was very late in adjusting its program, that they only got a quantitative easing really way down the pike. So I think the two lessons I would learn from Japan is don't get yourself into this mess to begin with. It looks like China has got itself into a bigger mess than Japan, and that when it does occur, don't minimize your problem, that you've really got a big problem now to turn around that economy. So you better move ahead rapidly with reform. You better have stimulative policies that make up for this, but it's not really going to be easy because this is really a very big problem. So I think China is in for a long period of slow growth along the Professor Aliber line.
Derek?
I just add a little bit to that. The one thing that my impression, again, I hate talking about comparing China and Japan because I just don't know that much about Japan in the 1980s, but it looks to me like Japan is still excessively interested in its external economic performance as compared to its domestic productivity. And that's something China has to avoid as well. And I don't see the obsessiveness on the Chinese part. But big economies, the US, China, Japan, maybe India, Germany / its satellites in the EU. Now I've offended people in the audience, yay. The big economies, you got to take care of your own business. And if you're looking at the world to boost you or trading with the world because you're messing around with your exchange rate or something like that, you're going to get yourself focused on the wrong thing. And my limited knowledge of Japan says the Japanese have been too interested in their external accounts, and China needs to avoid that problem. I, of course, agree with Des that we're getting a little bit late in giving them advice to avoid some of Japan's problems, but a China that's really focused on its domestic restructuring and not as worried about its external balances, that would be a step in the right direction.
We'll take one, what you wanted to. Bob is waiting, and then we'll get you, Yukon, as well.
I think one lesson from the adjustment in all financial crises is that the polity lags in recognizing the losses. So there's a big disagreement between us on whether the losses are 16% of GDP or 80% of GDP or 3 times, whatever. But those adjustments and the recapitalization of the banks should occur as rapidly as possible. That's an insight from the Japanese experience. And the rationalization of industry, essentially figuring out what to do with the dogs, with the excess capacity, inefficient firms, and releasing those resources so they can move to more productive activity elsewhere.
Your question is going to get a comment from every member of this panel. Yukon and then Nick.
I think there are 2 areas where they're watching Japan's experience and trying to figure out what to do. One is the exchange rate management. They look at the Plaza Accord and they think that destroyed Japan. Currently, they're stuck. If they depreciate the currency, they're under attack, and they need to, but they don't know how to move to a more flexible exchange rate, and they're trying to figure out how to do it. So that's one area. The other area what they're very much puzzled by is Japan was the most innovative economy for decades. How come it didn't grow? Okay? Now, China is actually pouring tons of money into innovation R&D, and the big issue for them is how do I actually duplicate a Korea experience, which did the same thing, but actually took innovation and was able to grow, as opposed to a Japan situation where they innovated and did all sorts of things, but they didn't grow. And this is actually coming out very slowly in terms of China's innovation policies and its industrial strategy.
I'm glad that Yukon brought up the example of South Korea, because one of the enormous differences between Japan and China, to belabor the obvious, is that Japan has been a constitutional democracy for well over 60 years. And you have a different sort of, although you may have technocratic issues with which to address questions, with which to address macro problems that will be similar in a constitutional democracy and a different sort of system. There are many, many other differences. South Korea, I think, is a much more interesting analogy in some ways to the Chinese situation, because it grew very, very fast in the 1960s and the 1970s under what we might politely call a military dictatorship. The fascinating part of South Korea's success was making the transition from a autocratic government to a constitutional democracy and keeping economic growth going at a slower pace, but at a sustainable pace. And I would think that there are an awful lot of questions that would be pertinent for informed Chinese citizens in looking at the parable of South Korea for the future.
Thanks, Nick. I'd like to get a question from back over here on this side somewhere. Did I have some hands back here? No? Okay, yes, ma'am.
Thanks for your presentation. My name is Li Yang. I just wonder, from both systems, the China and America, and I think at the beginning, way back before, Americans really hate communism. It's not negotiable. They think communism is a crime if you belong to it. Now we are talking about two systems going to the same direction, use GDP to measure everything about their income. And now we have a bubble housing. We have unoccupied apartments by million units. I just wonder, is this a very deviate from what we call free market, or is the free market in capitalism defined in the wrong way? So is there any study to measure exactly what's the difference if we want to measure the Chinese growth or the well-being of Chinese people? I know within capitalism, in practically in the whole world, everywhere is saying a failure.
Okay. Anybody want to take that on?
You're asking a really big question, and I don't do well with really big questions. I leave those for Paul Krugman. I'll say the following. I think it's entirely possible that you could get, this is relevant to your question, looking forward, you could get very weak Chinese GDP growth performance. That's what I expect. And I don't mean what they're going to announce. I don't care. But you use proxies and you're looking at no Chinese growth or very little frictional Chinese growth that's dependent on vagaries of global cycles. But you could still get improvement in Chinese living standards, because I think we've had income repression for ordinary Chinese. Household income has been repressed relative to economic expansion for an extended period. So a proper restructuring of the economy means people's actual money that they have, not headline GDP growth, which doesn't go to anyone, can grow faster than GDP. And I think something, and we disagree maybe on whether how likely that is, but I think something that's happening right now, which is very important to living standards, is a lot of the environmental destruction, which intensified under the previous government, has been recognized and slowly starting to be reversed. And so the environmental conditions in China, I expect to improve. I think they're already improving. It's hard to see. This happens slowly. But I think environmental conditions are improving. So I think you could get a GDP growth figure for China that's worse than what Nick's projecting out of his model. It's just bad. But you could get income gains for ordinary people that are okay, and better living standards by an improving environment. So I didn't really answer your big historical question, but I do think it's possible that we could be here 5 years from now saying, wow, China's GDP is terrible, but life for ordinary Chinese has gotten better.
Bob says he has a 30-second comment, which is lucky because that's just how much time we have.
Well, there's been a lot of chatter among the panel about the negativism. One has to appreciate the brilliant success of Chinese growth in the last 35 years. 300 or 400 million people have moved from dirt floors to indoor plumbing. When I visit universities, I am impressed with the fit and finish of the universities. I'm impressed with the number of people who are studying at universities the first ones in their families. I'm impressed with the number of Chinese tourists that I see in South Asia and in the United States. So the achievements reflect the sort of the savings, the entrepreneurship, and have just been brilliant.
I think that may be a good place to stop, ladies and gentlemen. We're at our adjournment time. Thank you very much for coming, and let's appreciate our great panel. Thank you all.